Well, here we are again. We're talking about income statements. I know that, that sometimes this is not the most engaging subject. And that's probably not the thing to say right off the bat. But I'll tell you what, if this is your business, then taking a look at when you're growing your business, when you're involved in your business, when things are going well, you really want to take a look at this and look at it on a regular basis. You want to look at it all the time too, so that you can correct anything, you can change directions, and you can actually be meeting your goals. So in my management class, we talk a lot about missions and goals, and here's where, most people, they say, well, I don't know what I ought to shoot for as far as being specific and having a deadline and dates and that sort of thing within their goals. But I mean, the financial statements, the balance sheet, the income statement, and the cash flow give you a plethora of numbers that you can work with, and they're real if you're accurate. So this is the mining field. This is where your hands get dirty when you're in the office, and that's really important for a manager to actually have a personal touch on their bookkeeping. So anyway, we're going to talk about income statements today, and I hope that you find it interesting. And if you haven't been, you don't know much about it, hopefully you'll pick up a few things and some things stick, and as you learn and put your own numbers in there, you'll come to find out that the income statement can be a real friend in the total management of your business, along with the other financial statements. So the income statement shows the firm's revenue and expenses and the taxes. Everybody's hung up on taxes, and like I've said before, it's just one of those line items in your income statement which you need to manage. And it's one of those that we can effectively manage if we know what's going on a little prior to the end of our fiscal year. So the financial period that we talk about within this statement is your fiscal year. Many operators in small business choose January through December as their fiscal year. This is an election that you actually apply for or check the box for when you first start up your business. If you operate under some other fiscal year, such as the school actually operates from July to June with their budgeting, so it may be a little bit different, but it's the same concept. It's just a 12-month period that we actually choose in order to report our income taxes, and it may be very effective to choose the right period for a business as well. One of the things with the advent of computerized accounting systems and record-keeping systems is that we can actually choose whatever one we want when we want to look at it for management decisions, which is just powerful. If you want to look at a cow-calf operation from breeding time until you sell your calves and wean them, or even extend it out to when we actually sell our yearlings, we can take that whole period, maybe a 20-month period, and have that as our year that we look at our income statement or any of these statements, which is really powerful. Again, the income statement is over a period of time. Right? It contrasted to the balance sheet, which is one snapshot or one day within that business. Okay, so there is a difference there, but we can still perform some real simple trend allowances or glances at it, analytics to it, to see how we're doing. Profitability is the bottom line of an income statement, and certainly if we're not profitable over the long run and possibly over the short run, we're not going to stay in business. The markets will actually dictate that we leave. They're going to ask us nicely at first, and then they're going to boot us out the door when it comes to that. So anyway, markets and agriculture and other small business enterprises are very efficient if we don't turn a profit over the long run, especially if we don't have any cash backing, then we don't stay in business. And there's not any reason to either when it comes right down to it. So let's just take a look at a real simplified type of an income statement. This one doesn't have, it's not specific at all, but you would have all of your sales or revenues on the very top of that particular statement, of the income statement. The gross profit is actually one which is it decreases the sales by the amount of those things which are already ready to sell. Okay, and a lot of times, most of the time in ag, if we're talking about farming and ranching, we don't actually buy something that's already manufactured and ready to sell. You might have a side hustle that does. So that's why I spend a short period of time here, and I'm big on that sort of thing. So if you have any questions about that or just want to talk about it to a certain degree, I can. I just love to visit about that stuff. You might do some cabin rentals with Airbnb. You might have a recreational enterprise like most of us do out there on the land with hunting, fishing, recreation, and that sort of thing that generates a little cash flow and profitability and an injection into the business when we talk about it. So it's not just those kinds of things. So anyway, the cost of goods sold in the line item that we have in this real general, simple income statement is those goods and services that we actually resell. Okay, a bushel of corn or barley or a calf that we actually raise would actually have expenses that are put into it throughout the year or our production period, and they would show up later on in the income statement. Okay, so that's where that one comes in. We get what we call an accounting gross profit after we deduct those costs of goods sold. So anyway, the earnings before interest and taxes, sometimes we pull those out and look at them a little bit separately for various financial reasons, and one of them, and I've been validated on this quite a few times, is that the taxes are so important, and they are to a certain extent, and we need to manage how much we pay taxes, how much of the tax is a percentage of our bottom line, and that sort of thing. So it is interesting, although it is just an input cost to the business when it comes right down to it. One that's very manageable, and the federal government, state governments actually allow us to manage it legally. So that's a great thing. When we get to actually determine our own destiny within that realm to a certain extent. Interest is an interesting thing because it's usually one of those items, especially, and I've got a lot of history here, started teaching in the 80s when there was the financial farm crisis, and most of you may not even been aware of that. Many businesses were failing, farms and ranches, and the cause, at least in the media, was that it was interest that was causing those failures. But in fact, when you drilled down into it, even though we had a high cost of interest and borrowing at that time, actually it was some other management things, and the markets in combination actually caused those businesses to fail and people lose their farms and ranches during that period of time. But anyway, it's interest expense is just another line item on the income statement, and one that we should and can manage to a certain extent, especially if we're highly leveraged. So it's interesting to look at it, an income statement with it pulled out and actually put back into the profitability picture. So that's how we figure that. Now, before This is a real simple corporate income statement. We have net income before dividends. Dividends are simply the profits after taxes have been paid by the corporate entity, the business. Okay, they've been distributed to their shareholders. The shareholders are the investors in the business. So they're going to expect that periodically to actually get some of those profits back to them, and then call these dividends. They're just no more than after-tax profits. For most of you, if you're not a corporate entity, you'll be looking at this net income before dividends. Okay? And then we can transfer whatever's left in the business as far as profits, and we transfer that to the retained earnings. Now, we're going to get into this in more detail as we go along, but all of these actually are reflected or affect the balance sheet. So these two statements, the income statement and the balance sheet, are heavily dependent on each other. But the income statement, as we said before, actually takes in a full fiscal year, most generally, depending on how we're looking at it. Okay? So let's get into a little more detail on the income statement. Okay? So the income statement is 1 year, and we've kind of gone over this, but I want to emphasize that it's for a period of time, generally 1 year. That would be a fiscal year. Expect to know that. Okay, last year to this year, another year to this year. When you put two income statements that have happened in conjunction, or say 2018 and 2019, and look at them side by side, it even gives us more information. When we were strictly doing all of our entries by writing them down, it was very hard to build these things, and it was time consuming. But within just a few keystrokes with a good accounting program anymore, we can actually look at these things and analyze what's going on in the business from a moment-to-moment basis, so that gives us more power. One of the things that we're going to have you do once we have generated, or we have a generated income statement, is actually look at some ratios, just like we did the balance sheet. Now, the first one is return on assets, which you can recognize it's directly dependent on the balance sheet, since we're going to use the total assets figure in this ratio. And we're going to take the net income, which is profits, okay, and we're going to divide that by the total assets. Now, we usually show this in a percentage figure, so you're going to have to move your decimal place in order to actually get the percentage. So the ROA, as we call it, is the return on the resources that are used in the business. And that is so that we can compare it to other investments. Okay, right now you can almost 2 to 3% in savings accounts. So if you're not generating that kind of return on your assets, you could actually invest those resources. Not that you're going to do it. It's a comparative analysis, a quick, down and dirty type of one that you can do. You could also compare it to some other vehicles as far as investment analysis. And then you could go off and go to the Bahamas. Right now you don't want to go to the Bahamas, of course. But if it was a higher return on your assets. So what I want you to do real quickly is just, and I'm going to pause this thing for a minute, or you just pause the video and calculate if you have $100,000 worth of assets and this income statement. We want to do it before dividends, so you have net profit, net income of $41,938. What would be your return on assets? Okay. Now do that if you have $1 million invested in assets, and then $2 million. Okay, write that down. The second ratio that we want to take a look at is your return on equity. And as you remember from the balance sheet, we actually calculated that that's part of the accounting equation, assets equal liability plus owner's equity. And this would be that same net income before dividends divided by your owner's equity. And this is an important figure because, as we know, if we're leveraged at all, meaning we're obligated in debt to a certain extent as a part of the business, part of those assets are owned by somebody else. So we want to determine what our return on our investment, our owner's equity is in this case. So it's the same, very simple calculation. And we can, again, we'll be able to do some comparative analysis on this one. It's real simple, it's real quick, it's down and dirty type of analysis and analytics. So it's not anything, no heavy lifting there, but real powerful kind of information to run your business with. So we can do the same things. I want you to perform the return on owner's equity as if you had $50,000, as if you had $500,000 on your balance sheet for owner's equity, and if you had had $1 million as your owner's equity within your balance sheet for total asset, or owner's equity on your balance sheet. Okay? So pause the video, calculate those ones up. Okay? I'm just going to give you, we're flipping right back to the return on assets here. And in this case, if we had $100,000 of assets, we would have a return of 41.94%. Okay? It's only $100,000, and as most of you know, that's not a whole bunch to have as invested in assets and in a particular business. But anyway, if you had a net income of $41,938, that's how much that would be. A very simple calculation. If we had $1 million, okay, we're going to move the decimal place over one figure. We actually have a 4.19%, which would be better than a savings account, right? If we could generate that over a long term over the long term, it might be something very acceptable, especially in agriculture. The average return on ag right now, and has been for many, many years, is 1.5% to 2% return on assets. So that's kind of the thing that you can expect there. If we had actually $2 million invested in ag, in our total assets, then we would cut that in half, right? So it'd be a little over 2% as far as a return on assets. Okay? So that's a really simple down and dirty type of a calculation. If we calculated the return on owner's equity here, we would have, with $50,000, we're almost generating as much net income as we do profits. So there's almost a 1-to-1. There's probably about 90%. I'm just kind of ballparking it right now. I'm going to let you do the calculations on that. We increase it to $500,000 worth of owner's equity, and of course your percentage return on your equity is going to decline, and I'll let you calculate those numbers. Make sure you know how and are comfortable calculating these numbers given a different income statement, okay, and balance sheet, of course. So how do we compare these ratios? And I alluded to this earlier in the video, but we can take a look at other periods within our own business. And this is very, very powerful just looking at different periods within our own business. I always say that, your first comparative analysis actually comes from yourself and maybe your past self, your past business self. So those are powerful things. What kind of trends do we have? Are we increasing the return on assets per se, in this case, or return on equity, or is it declining, or is it very stable? There may be some industry standards that you can dig up, just like I told you, on average. Of course, who wants to be average? Hopefully you're not on the bottom side of that one. If you're doing better than the average, that may be, at least a rung on the ladder that you want to hang on. You can compare it to somewhat non-risk return on capital. Right now I've got a savings account that returns over 2.5%. So I would actually want to have a better return on my assets than I do in that case. So that's what I would actually be shooting for in that case. Or you could actually use something, the return on investment in stocks. Stocks do 8 to 9% on average, not every year, of course, and this year's a little bit, and last year were a little bit of a down year for the stock market, but we could use that as also a comparative analysis, 8 to 9%, maybe up to 11 or 12. It has been over long periods of time, actually. So those are the kind of the standards that we can use for that sort of thing. And if you have any farm business management data for your state, that may be another source that we could actually do some comparative analysis with your ROA and ROE. So in order to reflect true profitability, we actually have to do a couple of manipulations, especially I think we alluded to the fact that we actually most of us will run, especially because we're so conscientious of taxes and the deductibility of some of our expenditures over the years, we're going to have to perform a few manipulations in order to get a true profit picture. And we do that, some of the big items that we do, just to keep it practical and simple. And I'm always a fan of keeping it practical and simple so that we actually use it. The numbers that come out have to be reflectively accurate, though. So we're going to do some changes in inventory on the revenue side of things, and then also changes in inputs on the expense side of things. So, for instance, on the revenue side of things, just to give you an example, if we put up a lot of hay and we have 500 tons of hay valued at $100 a ton, we would have to do the calculation on what that value of that is as far as our inventory goes. That would be a current asset. Okay. Now, at the end of the next year, at the same time, we would take an inventory of that hay, and if we have 1,000 ton valued at whatever the going rate is for that particular crop, we could have a change. We would have to change it to dollar values, but we could have a change in actually inventory value. And in that case, we would actually show more income because of that change in inventory, because we increased our hay crop inventory from 500 to 1,000 ton of hay. Okay, we can do that same thing in order to make an expense side change, and we would do that with major items in order to keep it practical. And I always think about the fact that there's a few items that sometimes we prepay for the year before. I always say if you're gonna use it that year, then go ahead and expense it when you pay for it in all practical senses. That doesn't follow truly generally accepted accounting principles, but it's a wash. if that's the reporting year that we're going to actually expense it. And it will be reflected accurately within our profit picture. On the expense side, if we have a fertilizer or a fuel prepayment, we buy it ahead of time. And a lot of times when we're managing our income taxes, if we're doing it ourselves or we're talking to our accountant, your accountant might say you need to spend some money so you don't show so much net income, therefore you'll pay less tax. He might say, what do you need for next year? Well, maybe you need 10,000 pounds of fertilizer, and you can prepay for it, and you can store it or store it at the local co-op or that sort of thing, but you actually own it and expense it on your income taxes at that point. But it's actually not going to be used until the next production year or next fiscal year. In that case, we would actually make an adjustment to our beginning inventory versus our ending inventory. We'll go through a few gyrations on that as we go along, and maybe later on in the semester we'll get into the real detail. I really want you to be able to read the income statement within this next lesson. Depreciation is another major expense, and the IRS has a whole bunch of different ways that you can deduct the investment in assets. So, and we'll get into the detail of that, but it is a major expense that would be deducted from your actual sales on your income statement. So a depreciation expense would be also an adjustment to your net income before you come down to the bottom line and show your profit. Okay? I've gone through most of this for your information. I've included a couple more slides, and I know this video is getting long, so I'm going to cap it off here. It just shows you a little bit about inventory changes. You can look it up under the text reading, and I encourage you guys, if you're interested in this stuff, and you should be if it's your business. I know when you're trying to learn it and you're studying other numbers, it's not as personal. But I want you to make this as personal as you can so that you can take this, put it in your toolbox as a skill or a tool, and use it on your own business so you can actually reflect what really true profitability is and analyze it. We've got to have the whole emphasis of this class is that we need to have accurate numbers so that we can make great management decisions. So anyway, if you have any questions, you can give me a call. I really like to, usually questions lead to questions, and also I just love to get to know you. And so give me a call if you have any questions on this sort of thing, and we'll move on, and we'll talk at you later.